Hey everybody, it's Andrew Cady, Epic Mortgage Guy. Happy Friday, March 27th to you. Hopefully this video finds you well. Just wanted to take a few minutes and break down some detailed information as to why we're seeing the changes that we're seeing in the mortgage business. It's pretty universal right now. Most lenders across the board are putting minimum credit score requirements specifically for government loans. Some pretty crazy overlays from some lenders. Some lenders are financially struggling very, very bad right now due to things called margin calls. There's a non-QM market that's effectively dried up at this point. The jumbo market is seized for most lenders. And this video is going to break down very, very in depth why this is happening. So bear with me. It's going to be a long video and we're going to get super technical, but I'm going to try and keep this as layman terms as humanly possible. Now, before I dive into this, I do want to give an opinion of optimism here to you guys. This video is not meant to be doom and gloom, but it's meant to be put out as a realistic view of what's going on in the mortgage business and why it's going on in the mortgage business. Do I think we're going to bounce back from this? Absolutely. Do I think we're going to see some lenders potentially not bounce back from this? Yes, I do. But that's how these cycles work. The old Warren Buffett quote really, really does ring true right now. Only when the tide goes out do you see who's been swimming naked. And for people that weren't prepared, people that didn't have cash reserves, companies specifically that didn't have cash reserves, that haven't been running their financials properly, it could be very trying times for them. We hope to see nobody go out of business. We hope to see nobody shut down over this. But the reality says we're in for a little bit of a ride here. Do I think housing bounces back? Unequivocally, yes. This is not a housing-driven crisis like we saw in 2008. This is a pandemic. This is a medical issue that is crashing our markets, and it is impacting the housing market, specifically in the mortgage market right now. And so I want to break it down for you. So bear with me. So first and foremost, let's talk about QM versus non-QM. QM versus non-QM is a very famous term that we use in the mortgage business, but you as a consumer, a real estate agent, a professional might not understand that. QM refers to qualified mortgage. Non-QM obviously is a non-qualified mortgage. What that means is your run-of-the-mill mortgages are QM loans. That's going to be your conventional loans, your FHA, your VA, even a lot of your jumbo products are conforming loans. They're going to be a qualifying mortgage. Your non-QM loans are going to be bank statement loans. They're going to be one day out of bankruptcy, high DTI, some asset depletion loans, some kind of the crazy lending that we see out there. Those are going to be your non-QM loans. As of right now, non-QM is effectively dead. There are still some lenders out there closing their active pipeline, maybe one or two that are actively locking, but for the most part, it's effectively shut down. The reason for that, non-QM mortgages are primarily bought up by hedge funds. They're primarily bought by investment groups. And when investment groups see their profits drop 30% with the stock market, they're very, very cautious about buying risky backed mortgages. And so the mortgage, it's just crazy to see 60 days ago, we were talking about new non-QM products rolling out. Today, the market's effectively seized. Some of the big name non-QM lenders have suspended services altogether, staff being laid off. So that's one thing we're seeing. Some of the bank statement loans, the majority of that stuff is done and gone. We're seeing a lot of lenders, and we're going to probably hear it as well here today with my company. We're going to be overlaying minimum credit score requirements for government-backed loans. Government-backed loans would be VA, FHA, USDA. Now, you may ask, why government-backed loans and not the rest of the loans? Well, there's a kind of a big problem on the servicing side of a loan. Now, let's talk about servicing. Servicing is the company that you pay your monthly payment to on your mortgage. They don't own the mortgage. They operate much as a landlord who collects rents and pays it to the owner of the property. They're going to service your loan and they're going to earn money to do that. They get paid a stipend to basically service the aspects of a mortgage. Well, on a conventional loan, Fannie Mae, Freddie Mac, there's provisions in there that if for some reason the buyer, the homeowner cannot pay their payment, the servicer is on the hook for one payment. They have to pay the investors one payment before they're given relief. However, on government-backed loans, there is no provision for that. The servicer's on the hook for the term of the loan. That would either end after a forbearance. And this is also talking about this forbearance that the government put out. So the government's talking about allowing homeowners to go into a 6-month, potentially longer forbearance on their mortgage payments. Government-backed loans that are serviced, this is going to impact servicers extremely heavily unless there's some kind of a provision given by the government to protect the servicers in this case. So right now, servicers are very, very cautious in buying and in taking on portfolios of government-backed loans because of the risk of the servicing side. That risk is highly elevated. Yesterday, we got the unemployment numbers out at 3.28 million. Staggering number in comparison to our worst day in history, October 1982. It came out at 695,000. The worst unemployment report we saw during the 2008 downturn was 665,000, and we hit 3.28 million. Now, everything on the servicing side is relatively trucking along. The next 15, 18 days is what's going to tell the story on servicing, because the people who paid their March 1st payment were very, very much employed in February. But now that we've seen 3.28 million people in 1 week go to unemployment lines, there's a lot of questions in the servicing business of whether they're going to be able to, those particular families are going to be able to pay their mortgage payments. We do expect another large unemployment number next week. And so servicers are obviously very concerned about it. And if they're on the hook for indefinite payments to the investors for government-backed loans, they're going to have a hard time wanting to purchase and insure and service those mortgages. So that's what's going on right there. So if you see overlays of credit score minimums going from a 580 to a 640, some lenders are at 680. Several predominant lenders have dropped out of the government space altogether. That's the reason why. There's a lot of compression going on the back end. Now, let's talk margin calls. Margin calls is something that's happening to lenders right now, and it's happening on a out of control number. So I'll explain how mortgage lending works on as layman terms as I can here. So when we lock an interest rate on a loan, let's say you're a consumer and I lock your interest rate at 4%. There is no such thing on the lending side as a locked interest rate. It's much more of a promise to you, the client, that you're going to get a 4% interest rate. Now, we as the lender, we have 30 days, 45 days, 60 days until that loan is actually sold off and the interest rate is actually locked at that point. So what happens if interest rates dramatically rise during that time? And we guaranteed the client 4%, but now it's 5%. What happens? Well, the lender loses a lot of money at that point because we have to honor the 4% lock that we gave the client. So what mortgage lenders do to subsidize that and to offset that is they short mortgage-backed securities. If you're not sure what a short position is you go in and let's say you buy Tesla stock today and you say, hey, I believe Tesla is going to run up, so I'm going to buy Tesla stock. And it runs up, you sell, you make a profit. Well, shorting a stock is when you say, I think Tesla is actually going to come down. So you borrow shares of the stock and you say, I'm actually going to short the position. So if the stock falls by $100 a share, I make $100 a share. You're essentially betting against the market. Well, mortgage lenders, in order to protect their interest of a mortgage interest rate rising in between the time we lock it and the time it closes, we short the mortgage-backed security market because it's a wash. If we short the mortgage-backed security market and the mortgage-backed securities get worse and rates go up, well, we just made money shorting mortgage-backed securities, which offsets the loss we had in rates rising before we could offload that loan. Alternatively, if rates come down, well, our short position is underwater. We're losing money on our short position. However, that 4% loan we guaranteed you is now going to close on the investor side at 3.5%, and we're going to make our money there. We may lose money on the short position, but we gain the money on the actual betterment in interest rate when we close the loan. So it's called a pair off. They take their losses in mortgage-backed securities with their gains on mortgage interest rates. They pair it off and they sell it off. Or their losses in the mortgage interest rates and their gains in mortgage-backed securities, they pair off and sell off. So it's kind of a wash. Well, what happens if we lock interest rates at 4% and interest rates drop dramatically like we saw a few weeks ago, and then they came back up, and we saw this a few weeks ago, interest rates dropped dramatically. Well, what happens? We've shorted mortgage-backed securities. And now our short position is deeply underwater. Well, that's what happens when we get a margin call. The broker, lender, investor calls the mortgage lender and says, hey, you borrowed the shares of the mortgage-backed security. You don't own them. And our position is deeply underwater. We're not comfortable with it anymore. We need to settle some of this spread. And they do a margin call. And the lender has to pay in cash that day their margin call. There's been margin calls with some of the biggest lenders in America that top $1 billion in a day. We're talking $150 million margin calls, $100 million, $50 million margin calls that lenders have to write a check for. And sure, they're going to gain that money back when those loans close. But what if the loans don't close? And that's where the insecurity is coming in right now. What if those buyers that we have an interest rate locked for, that we just had to write a big check in a margin call, what if they're part of the unemployment numbers and we can't do a verification of unemployment or verification of employment before we close, and now that loan's dead? We hedged the market against a locked loan that couldn't close. We lost money on our short position, and now we can't gain money on the closed mortgage. And that's where lenders are getting compressed extremely hard right now. And so you may see interest rates, even though the market's doing well, you may see interest rates rising with a lot, if not all, mortgage lenders. Why? Because they're hedging their bets that there's a percentage of these loans that may not fund. They're getting killed on margin calls, and they are capacitized out right now with a ton of mortgages that have come in from this refinance boom we saw 3 weeks ago that are sitting on the warehouse lines being underwritten that need to close to repay back the margin call offset. So lots and lots of details here. I'm trying to keep this as layman terms as possible for you guys. Again, I don't want this to be doom and gloom. I want this to be informational of how the mortgage business works and why we're seeing the changes we're seeing. Do we think that we're going to get mortgage credit scores come back down for government loans in the future? Yes, but it might be some time. Do we see the jumbo market reopening for locks? Yes, I do think jumbo is going to reopen probably sooner rather than later, especially for the high credit score, high asset buyers. Do we think non-QM mortgages are coming back? Yes, but that may take significant amount of time. After the crash in 2008, it took about 4 years for non-QM to make a resurgence, and we may see a similar situation here. So appreciate you guys spending your time with me today. If you guys need anything, you can look me up on any social media channel at Epic Mortgage Guy. You can find me, call my cell phone directly, 386-466-5557. Call my office, 904-500-EPIC. Thanks again for your time. If you guys need me, look me up. Have a good day and take care.